This is Cindy Finkenbinder. I'm with Alpha Omega Accounting, and we are here today to go over the basics of crypto taxes. There are over 200 currencies currently that are considered to be crypto. Bitcoin was just the first one, but for some reason that's the one that everyone thinks of when they think of crypto. Now, crypto is not backed by a specific country, and it may not have anything physical, such as gold, backing it at all. In contrast, fiat currency is backed by a specific country, such as the US dollar is backed by the US government. The ruble is backed by the Russian government, things like that. Oh, I did want to let you know that there is a chat screen up, so if you have any questions, go ahead and put it in the chat, and then I can get those answered. Now, in order to track currency, it is absolutely mandatory that you are completely accurate. Now, the nature of blockchain is to be accurate. However, there is no mandatory requirements for reporting that there are for stocks, such as getting a broker statement and things like that. And because of that, you have to track your own crypto and make sure that your tracking is in place and is correct. Now, the IRS does know that you have cryptocurrency. They have won several court cases that now require the crypto exchanges to reveal who has accounts. The biggest one was Coinbase, and Coinbase is now required to provide to the IRS every year a report that says that they are a report that shows that they are who each person is and either a social security number or EIN number. So they do actually know who you are. So you cannot get away with saying, hey, they don't know me, so I don't have to report it. Now, in order to acquire crypto, it is normally through an online exchange, such as Coinbase, and you purchase it using fiat currency. It can also be received as a payment for services. Each person has a wallet. Those wallets are show who owns whatever crypto you have in there. Basically, it's a place to hold crypto, similar to a wallet that you would carry in your pocket. It is highly recommended that any crypto that you have that's being held for an investment is in what's called a hard wallet. Basically, this is a special USB type of a thumb drive that has some special ledger style software on it. A soft wallet is downloaded to your computer or your phone. You can also have a paper wallet, which is printed on paper, but it's harder to get those back up on the exchange. And the exchange can also hold a wallet for you, and your balance is held at one of the many online exchanges, sort of like a bank. If your balance is not held at an exchange, then it has to be moved onto an exchange in order to trade it for other crypto or convert it back to fiat currency or to be used for purchases. Each wallet has a key. You have a public key that allows you to send or receive crypto, and then you have a private key that controls your wallet. Now, these keys are linked together to form an algorithm or signature. The keys cannot be recovered if it's lost. So in most instances, if you lose your password, your wallet is lost. So make sure that that is in a place where you can access it at all times. Also, make sure that that at least one other person knows where to find that in case you are, incapacitated, or if something should happen to you, because otherwise your heirs will not be able to access it at all. Now, the IRS regulations are based on IRS Notice 2114-21. It was issued in 2014. This is a 6-page document. It is the shortest tax-related regulation ever to be placed into law. Widespread non-compliance has led to cryptocurrency being one of the main targets of the IRS investigations. It's also been investigated by the Department of Justice, the Security Exchange Commission, the Commodities Futures and Trading Commission, and the Financial Crimes Enforcement Network. Now, each time that you do crypto, not everything that you every time you do something using cryptocurrency will be a taxable event, such as purchasing Bitcoin with fiat coin is not a taxable event. However, when you turn that coin back into fiat or trading your Bitcoin for US dollars, it is a taxable event. So you have to make sure you watch that. Anytime that you go coin to coin, so if you're trading Ethereum for Ripple, then Ethereum for Ripple, then you are creating a taxable event. If you purchase something with your coin, so if you pay for it with your tax prep fees with crypto or Stellar, then you created a taxable event. Anytime you receive coins for goods or services, this is slightly different because this is the only one that is ordinary income instead of capital gains income. This would be somebody that's doing mining. All normal taxes apply depending on how it is received and held. You can also have your crypto be subject to backup withholding and even payroll taxes if it is used to pay employees, contractors, or foreign investors. All crypto is considered virtual currency by the IRS. Now, that does not mean that every single type of crypto or every digital currency is a virtual currency. If you're playing Farmville on Facebook, that is not considered a digital currency by the IRS because you cannot convert those that money into fiat money. So you just have to remember that sometimes it's not considered that, but 90% of the time, if you're dealing with crypto, it is considered to be currency by the IRS. Now, it's not currency, it's considered property, but it's not, because it's not a functional currency. Crypto can be treated as stock, collectibles, a commodity, a security, or even income, depending on how you intend to use it. It can also be considered as foreign currency, depending on the location of the exchange and the origination of the crypto itself. So if your exchange is located in a foreign country, you may have foreign filing requirements. If the crypto itself is considered originated in a foreign country, then it is considered a foreign currency and you have to disclose that. Now, the capital gains have to be classified as long or short term. Now, because it is considered an asset, cryptocurrency has to be is subject to capital gains tax for the U.S. Now, other countries are going to be a totally different tax situations. You need to check with those countries if you would be subject to their taxes. Short term, of course, is held less than 1 year, even if that's only for a few hours. The tax rate is between 0 and 37% depending on your total income and your filing status. After all of your sources of income are taken into consideration. Long-term capital gains are held over 1 year. The tax rate is between 0 and 15%, topping out at the 15%. So long-term is going to be better for you than short-term, unless you're in that 0%. There are some exceptions to this. Anytime that you inherit cryptocurrency, you will automatically be considered long-term no matter when it was purchased. It could have been purchased yesterday and then be inherited, and now it's got long-term. Wash losses do not apply because it is classified as property, and wash sales only apply to specific, or to, they only apply specifically to stock. You can also not use a 1031 exchange because this applies only to real estate and nothing else. So for example, on a normal stock purchase, if you purchase 10 shares of Apple on 6/15 of 2015 for $126.10 per share, or $1,261, then you sell that on July 16th, 2018 for $191.51 per share. So then you have an income, a long-term capital gain of $654. Now with cryptocurrency, if you purchase one Bitcoin for $5,300 US dollars, then you sell it for $10,700 US dollars, then you have a short-term gain of $5,400. And so you have to really watch when you're purchasing these to make sure that you get your losses in there. Gains and losses both apply. Now keep in mind that any losses for cryptocurrency, you are subject to a $3,000 limit for most people, unless you are qualified as a qualified investor. In order to figure your basis, you have to take your taxable income and your capital gains. You have to know the cost basis of your crypto. So if you purchased it directly with fiat, then it would become the purchase price. Sometimes you have to calculate your cost basis down to the exact time of purchase instead of just the day, because some coins fluctuate significantly during the day. An airdrop has to be calculated based on the date received. Caution: if these are a reward, it can be considered ordinary income. Remember that bartering is still considered income. It's as if you are rewarded for a service. It is still income. A hard fork is usually treated like a stock split. However, the IRS has not given us any details on how we are supposed to do this, and so there are some fluctuations in here. Some accountants will just give it a zero cost basis, and others will split the cost with the original coin that was held with the new coin. So it'll change the cost basis of both your original coin and the new one that you now hold. So be cautious with hard forks, because you have to really keep track of those very well. Now, when you are purchasing one coin with another, such as you are exchanging Bitcoin for Ripple, tracking those cost bases can be extremely hard, because you have to convert the cost or your cost into US dollars first. But that's not the way the exchange works. On the exchange, you just trade directly Bitcoin for Ripple. But in your calculations, you have to actually figure out what the fair market value of that coin would be on the date that you did the trade. So you have to track those each and every time. Your losses are governed by Section IRC 165 of the IRS, the same as all stock and commodities are also subject to the 165. Theft. Crypto is considered property, so you have to prove that it was actually stolen and not lost. If you just lose your password or key, it's not considered a taxable loss because you lost it, it was not stolen from you. Scams. Now these normally happen, with phishing scams and things, and it normally says that it's some kind of a ICO, which is when an initial coin offering. And so a lot of these scams can come up. When you lose it with a scam, you still have to prove that it was a scam. Worthless stock. It has to have a zero worth. Even if it has a value of a half of a penny, it still has a worth, and therefore is not considered worthless. If your wallet is hacked, your loss is capped at what it is reasonable that you might get back, even if you're getting that back through insurance. Now keep in mind that as an individual, starting in 2019, you can no longer take personal losses. So these would have to be a business loss. So you'd actually have to be holding your crypto in your business in order for it to count as a loss. If it is an individual personal loss, you cannot take this on your tax return. Crypto mining. Instead of moving soil to find minerals, you use a computer to find and prove each transaction. Miners are typically paid in crypto for their services, and it's the same as any other business. The income is then treated as business income, so it would be ordinary income, but it's also subject to capital gains when it's sold or used to purchase something. So if you are paid in crypto on one day, but you don't sell it until the next day, or you don't use it until the next day, then you can have a capital gain or loss for that particular transaction. Mining income, of course, is taxed as ordinary income. It's reported as income on the tax return depending on the type of entity, such as a sole proprietor would be reported on a Schedule C, and it would be reported on a 1120S for a S Corp or a 1065 for a partnership. Now that same income will also generate capital gains or losses when it's sold or it's used to make a purchase. So you have to keep track of your cost basis even when you're doing mining. There are several expenses that, because you're mining, it is treated as the same as any other business. So all normal business expenses apply, including payroll. You can have equipment, software subject to normal depreciation rates for any business. Utilities is normally your largest expense. So if you are using your home office for doing your mining, you have to really keep accurate records of how much in the areas of where each of these is used. Maintenance, the purchase of mining contracts, renting blocks of time from data servers, any of your local taxes, all of those would be deductible expenses along with any other normal business expense. So as an example, if you receive 1 Bitcoin for your proof of work, it is reported as ordinary income of $10,000 US. Now you take that 1 Bitcoin and you trade it for, and you purchase a new computer using Bitcoin. So your Bitcoin that you received was worth 10K in US dollars. You purchase the new computer for half a Bitcoin 2 days later. You have a gain of $5,250, or you use that for 5,000. Your Bitcoin is worth 5,250 US dollars on the date you purchased the computer. That means that you now have a total income of the original 10K that you received for mining, plus you have a $250 short-term capital gain income that you also need to report. Now this computer can also be written off as a business expense. So keep in mind that this may not, this may bring your net income down. So you have to really keep track of that. Other issues to keep in mind: foreign currency reporting. You have to report if it is held in a foreign exchange, then you are subject to the FBAR reporting from FinCEN, and you are also subject to the IRS 8963 forms, which reports foreign assets held. You can also be subject to the net investment income tax. If your income is over 200K, you might be subject to an additional 3% tax on all investment income. Since crypto is considered an investment, this can push you into a new tax bracket. So you have to really be careful with that and make sure that you are on top of it at all times so that you can make sure you have the accurate estimated tax payments and stuff made. There are a lot of penalties for not reporting the income. The IRS is very aggressive about crypto. If you willfully do not file, it can be considered fraud, and it has a penalty starting at 10K per year. Now then, in addition to that, if it is held in a foreign exchange, then your crypto is considered to be not US based. It's not a foreign currency, it is an asset. So it changes. Most foreign currencies, your threshold for, you have to have $10,000 at any time during the year will trigger having to report this. But if you, because it's considered a asset and not a currency, then that reporting threshold moved to 50K. That is reported on an 8938 with your 1040 or your business return, depending on how it's held. It also increases the statute of limitations for not reporting on it 8938. So it increases your statute of limitations from 7 years to 10 years if you do not report it. You also have a $10,000 failure to file fine and up to $50,000 per year for continued failure to file. And in addition to that, a 40% penalty on all non-disclosed assets. Now here's the kicker. You also have FBAR reporting. Now FBAR reporting goes to the FinCEN from their website, or it is e-filed. In this one, you have to do all assets that are over 10K unless you live abroad, in which case then it moves to 200K. The penalties, in addition to the penalties from the IRS, so you can actually get penalized twice for the same account. This one is 10K for failure to file, and if it's willful, they can impose a minimum of 100,000 or half the value of the account, whichever is greater. So this one is one you really do not want to ignore, because getting a $100,000 fine can put a crimp in anybody's day. So if you have more questions, call us for a free 1-hour consultation. You can keep on an eye on our blog. That's at the email, or the blog site is right there. We are also going to have a cryptocurrency white paper, which will be available on September 1st. So if you would like that white paper, just drop us an email and we will get that to you. Here's all of our information. Again, I'm Cindy with Alpha Omega Accounting, and here's our phone number and the email address. So if you have any questions, don't forget, you can drop us an email at any time, and we will answer you just as fast as we can. Thank you. You guys have a great day.